Welcome to Money, Finance, Wealth. Today, we're tackling a topic that impacts nearly every major financial decision, your credit score. A high credit score can open doors to better loan rates, easier access to credit, and even influence your ability to rent an apartment. On the other hand, a low credit score can be costly. But don't worry. By the end of this video, you'll know exactly what a credit score is, how it's calculated, and practical steps to improve it. This episode is brought to you by our sponsor, Fennel Wealth Management. Let's dive in. First off, what exactly is a credit score? In simple terms, your credit score is a number that represents your credit worthiness, or how likely you are to repay borrowed money. Credit scores usually range from 300 to 850, with higher scores indicating better credit. A high credit score can help you qualify for lower interest rates on loans and credit cards, which can save you thousands over time. Meanwhile, a low credit score might limit your access to credit or result in higher costs for borrowing. Your credit score affects more than just loan approvals. It can impact everything from the rates you get on mortgages, car loans, and credit cards, to your ability to rent a home or apartment. Some employers even check credit scores as part of their hiring process, so a good score can benefit you in many areas. A high credit score can give you access to better terms, making life just a little easier financially. On the other hand, a low score can limit your options and lead to higher costs over time. Now that we know what a credit score is, let's break down the 5 main factors that determine your score. Understanding these factors will give you the insight you need to start making improvements. Payment history, 35%. Host. First up is payment history, which makes up about 35% of your score. This is the most important factor, as it shows lenders how reliable you are at repaying debts. Late payments, collections, or bankruptcies can significantly lower your score. Host tip. Make it a habit to pay your bills on time. Setting up automatic payments or calendar reminders can help you avoid late payments and protect this portion of your score. Credit utilization, 30%. Host. Credit utilization, which accounts for 30% of your score, refers to how much of your available credit you're using. Ideally, you want to keep this ratio below 30%. For instance, if you have a credit limit of $10,000, try to keep your balance under $3,000. Host. Tip. Paying down balances and spreading your expenses across multiple cards can help you lower your utilization rate and improve this part of your score. Length of credit history, 15%. Host. Length of credit history, or how long you've had credit accounts, makes up 15% of your score. Generally, the longer your history, the better. Lenders see a long credit history as an indicator of reliability. Host tip. Keep your oldest accounts open, even if you're not using them. Closing old accounts can shorten your credit history and potentially lower your score. Types of credit, which account for 10% of your score, reflect your ability to manage different types of credit responsibly. Having a mix, like credit cards, auto loans, and mortgages, can positively impact your score. Tip. Don't open new accounts just to diversify. Focus on managing your existing credit well, and the mix will improve naturally over time. New credit inquiries make up 10% of your score. Each time you apply for new credit, it results in a hard inquiry, which can slightly lower your score. Too many inquiries in a short period can be a red flag to lenders. Tip. Only apply for new credit when you truly need it. Spacing out applications can help you avoid unnecessary impacts on your score. Consistent, on-time payments are crucial for maintaining a good score. Even one late payment can significantly affect your credit. Consider setting up autopay for minimum payments to ensure you never miss a due date. Keep your credit utilization ratio below 30%. Paying down balances each month, especially on high-interest cards, not only improves your credit score, but also reduces interest costs. Keeping old accounts open, even if unused, helps lengthen your credit history and supports a better score. Unless the account has high fees, it's often best to keep it open. Applying for credit sparingly helps keep your score stable. Only apply when absolutely necessary. And if you're shopping for a loan, make sure to do it within a short period to reduce the impact of multiple inquiries. Monitoring your credit report can help catch any errors or signs of identity theft early. Everyone is entitled to a free credit report from each major bureau once a year at annualcreditreport.com. Reviewing your report helps ensure accuracy and protects your score. A good credit score can unlock so many financial opportunities, from better interest rates to more favorable loan terms. By focusing on payment history, managing credit utilization, and monitoring your report, you're taking the right steps toward a healthier financial future. Thanks for watching Money, Finance, Wealth. If you found this video helpful, please like, subscribe, and share it with anyone who could benefit. And remember, for personalized financial guidance, reach out to our sponsor, Fennel Wealth Management, at 888-336-8586. Visit fennelwealthmanagement.com or email info@fennel.com.